Disney shares off just around 5% on the heels of their earnings report. Allie Canal joins us now with the numbers. Allie, what can you tell us? Clearly disappointment here at the street.
A disappointment on the quarter, despite that beat in subscribers, missing on both revenue and adjusted earnings per share. Revenue coming in at $20.15 billion versus expectations of $21.26 billion. Adjusted earnings also missing 30 cents a share versus expectations of 51 cents. Disney Plus subscriber net additions did come in above estimates, 12 million versus 9.35 million that was expected. Now on the park side, that also had a slight miss. Revenue from that division coming in at 7.43 billion versus 7.59 billion that was expected. If we take a look at how the stock is trading right now, it is down more than 5% in after hours trading. Now CEO Bob Chapek did try to have this optimistic tone despite this earnings miss. He says that the company expects DTC operating losses to narrow going forward and that Disney Plus will still achieve profitability in fiscal 2024. However, I do want to point out that a combined loss of $1.5 billion resulted from Disney Plus, Hulu, and ESPN Plus in this quarter. That's versus a loss of $1.1 billion in the third quarter. So despite Bob Chapek saying that operating losses are going to narrow, we saw this acceleration in this quarter. And analysts that I spoke with largely expected that to come down. Streaming profitability has been one of the most important things for investors. And I think that's really the main driver of this dip that we're seeing in the stock, along with the fact that we saw that miss on both revenue and adjusted earnings per share. We obviously have a lot of macroeconomic challenges along with foreign exchange pressuring profits, but overall not the best quarter for Disney. And I think this comes as a little bit of a surprise for investors.
Yeah, investors wanted to see the beginning of that story where streaming was just going to stop bleeding money. Now the subscribers exceeded expectations, but do we expect that their spend on content, Allie, would start to take a hit here in the months ahead?
I do think that is the case. Now, they have banked a lot of content. They've rolled out, exclusive movies like Hocus Pocus 2, Disenchanted, a lot of new programming coming to the platform when we talk about Marvel and Star Wars. So I do expect that content spend to slow moving forward now that they have that content coming out in the pipeline. So perhaps this is the peak of the loss. We know Disney CFO Christine McCarthy previously guided that peak Disney Plus losses will happen this year. So maybe this is the biggest loss that we'll see for the company. But investors really want to see that number come down because streaming at the end of the day needs to be profitable. Of course, we have the Disney Plus ad-supported tier coming next month that should help ease the blow of some of this content spend, along with some of those big franchise films like Avatar 2, Wakanda Forever. I'm sure they're going to tout that on the earnings call, and that will hopefully help lift things in the next quarter. But for now, shares again off almost 6%, or more than 6% now in after hours.
And you mentioned that that ad-supported tier that's going to be coming. They're also set to hike prices for the Disney Plus service as well in December, perhaps another way to boost revenue. I was surprised that the parks and studio divisions came in a little worse than expected, especially parks. We've sort of been talking about this reopening story for Disney, people sort of coming back, but then as inflation bites and people start tightening their purse strings, it's interesting that perhaps this might be one of the places, unexpected though, I think, when it comes to the parks, Allie.
And we saw in Disney's third quarter that the parks surged, and that was when international traveling was coming back. We saw a lot of people willing to spend despite those recession fears. And we've seen with the parks business that despite those price hikes and all the challenges that consumers have been facing, they're still willing to come out to these parks. Disney has increased the number of attractions. They've upgraded their technologies like the Genie Plus app. So there was this expectation that nothing could really touch the parks business, but we're now seeing a slight slowdown there. So we'll have to keep an eye on that. Perhaps this is indicating that there could be worsening economic conditions. Disney is sort of a bellwether when we think about consumer spending. So definitely an important company to watch moving forward. And I'm curious what they're going to say on the earnings call when it comes to the outlook for the parks, along with those gross booking numbers and where they expect things to go if things do worsen on an economic front.
Yeah, certainly they could take a huge hit in the coming quarters if, of course, we do see the downturn start to accelerate. All right, Allie Canal, thanks so much.